Okay, now to the advanced free cash flows. What are the steps which is going to cover in this chapter? And this is the last chapter of part one, how to find quality companies. Then we go with the review. So, is the company spending enough? Is negative cash flow always bad? Combining ROCs with free cash flow per share, how safe are dividend payments? When cash flow is not what it seems, manipulation of free cash flows. So, good 7 pointers to do. So, how do you know if the company is spending enough or no? What we do is we do a ratio called capex to depreciation ratio. So whatever the depreciation of the business is, this is in red, and if this capex is usually above the depreciation, then definitely it is a growth capex. What if this capex is somewhere around 80% to 120% of the depreciation rate? This is just my estimate. You are doing a maintenance capex. So for this, I have taken a company called Mega Unicorters. In the chart sheet, this is our depreciation to capex ratio with free cash flow to equity and ROC, which we're going to see ahead. So you see this here, this red block is the capex and this is the depreciation. This is maintenance. This is also not quite of a maintenance, but year to year it is expansion. This is how you get to know the capex to depreciation also. He's giving ratios of capex to depreciation of different companies over here. If my capex to depreciation is too high, that means I'm doing extraordinary putting assets on my balance sheet. But if my capex to depreciation ratio is too low, that means I could be under investing. But we cannot look at the numbers in isolation and see if this company is under investing or over investing. We need to study the business, we need to know the industry, if this is the industry norm or something more or something bad is going on over there. Okay, now for the second pointer, is negative free cash flow always bad? No, negative free cash flow is not always bad, because if the company is investing, no, this is free cash flow, not the cash flow over here. If the company is investing heavily to make his assets, and if we see our trend of the ROC is high, then negative free cash flow is not bad. It is actually very, very, very good, because he is putting up money which is earning into the business and earning good returns over here. So again, going back to the example of Mega Unicorters, you see over here the capex to depreciation line is this one. I click on these numbers so I can get the ratio, percentage ratios over here. From 37% it went to 98% of depreciation, and capex crossed that. But at the same time, my ROCE 32%, 26%, 18% was actually going down. But if this trend was reverse, 18% and 26% and 32%, अगर ये उल्टा हो रहा होता and ये चीज़ हो रही होती, your stock price would have definitely gone mad. Sorry. So this is what he's saying over here, and then he says EasyJet's investing heavily in assets. They are making some assets, and their cash flow to depreciation is way above 400%, and their ROC is 18-20%. It is rising, very good sign. And if you see, I'm not encouraging for this, but if you look at the figure for me, you see ROC was on the encouraging upward trend. This is what I said. ROC improved significantly, 400% capex to free cash flow, and दूसरा ये Sainsbury variable free cash flow disappointing ROE bad. So see the trend of the ROC versus your capex to depreciation ratio line, okay, which is they already have it in our sheet. Now the next is combining ROCs and free cash flow. There is a ratio called CROIC. In chapter 1 and 2 here we discussed about ROCE. Now CROC is adjusted free cash flow for the firm, and we saw how the free cash flow was calculated, and average capital employed. In the chapter 2 or 1, I think we saw about how do we calculate the average free cash flow, average capital employed. I think the recording is shared in the group earlier also. So anything below 10 to 13% in Indian context is good. Beyond 13% is very difficult to find. Less than 13%, that means you are not generating good amount of cash flows. So he says, I suggested 10% as a minimum requirement for this. I suggest you for anything between 8 to 13% for India is a good number. This is UK numbers. Again, he talks about this, and it was impressive 28%, and you find some. So companies having this kind of a free cash, CROIC, wow, amazing businesses, and if they are growing and sales and profits are rising, and this is the number, you have definitely have a gem. But if you have these kind of a numbers, you have a problem. Then why free cash flow to the firm? Free cash flow per share. Why do that? He is comparing this free cash flow to share by EPS. Again, we have all this done over here. This is our free cash flow to share. This is our EPS. So these two numbers should be more or less the same. But in this company, free cash flow, you'll see this is always negative or very less than the EPS. Not a good sign to be. Okay. But earlier on, this company had that kind of an example. Here he gives you the formulas. so on and so forth for Domino's. This we are discussing Domino's. Domino's free cash flow to per share, and if FCF, or you with compared with normalized EPS, more or less the same what we are doing over here. EPS and free cash flow to the equity per share. Now, why earnings per share and free cash flow share differ? It is important to understand the EPS and free cash flow will really differ if ever they sum. Profits of something, or revenues and costs, which cash flows tends to be more lumpy because depending upon the cash coming in out. So these are two reasons. Poor operating cash conversions. मेरा working capital stretch हो गया, मेरे को पैसे नहीं आए, मेरे credit sales. Some reasons we saw above, and higher levels of investments in new assets. That's why my cash flow will go to negative, because free cash will go to negative because I have done capex. And again he says, look at earning a descending ROE, and this number is bad, and ascending ROE, and even this number is good. You can go on and go forth. So FCF is 80% or more than EPS, definite good candidate. FCF is less than 80% and ROC is increasing, possible candidate. FCF is less than 80% of EPS and ROC is falling, don't go near it. FCF is consistently negative, don't go over. How depreciation can of assets can distort profit figures. Now depreciation is a thing which can be changed. I do my depreciation in straight line or WDV method. I change the depreciation accounting policy, which we don't really go and read. This can change my PAT numbers because depreciation is expense which is reduced in the P&L account. So he is giving some examples of a 10-year depreciation, how my depreciation goes and how my book value goes, and how this will distort your ROC numbers and PAT numbers. So all this is there, and then you comparing with free cash flow per share, normalized EPS, and you compare with the capex to depreciation line. Now, if I don't have a free cash flow to per share, which is negative or a very small number, how can I give dividend per share? If I'm giving dividend per share, which is DPS, and this number is low and this number is high, that means I'm taking debt or I'm doing some mischief to give dividends to the shareholders and make them very happy. So when free cash flow may not seem what it seems. Okay, now then he says why free cash flows are not what they look like. See, this company is giving example, the free cash flows were always negative and this guy was still giving dividends. So why so? Because don't go and look at the numbers generally and get to some understanding of it. Unless you don't know the business. See, this is a British land. This is a land acquisition business. So buying and selling of investments, I think the land is their work, which is there, that is happening. So if I go to screen here again, the company called Mayur Uniquoters, just for an example, I told you that when we go to the capex line, this is the capex line. Now some companies, what they will do is, this is the capex line, fixed asset purchase, and since it was a land company, fixed assets sold and purchase and buy and sell is their regular work. So in this case, you have to add back these fixed assets sellings, which we generally avoid because we want to be conservative. In this case, when he adds back these numbers to the cash flows, you suddenly see these negative cash flows are hugely positive. So see the nature of the business, then you decide, then you need to add back those cash flows which are generated from selling fixed assets. Now we are buying fixed assets, we are reducing that amount. When we are selling fixed assets, which is here, so we need to add this or no, that depends upon the nature of the business. That is why he says free cash flows can be very different from what they generally look. Now how can free cash flow be manipulated? Now this is a very deep concept. He is giving such only small insights over here. Delayed paying bills. What do I mean by delayed paying bills? My creditors will increase. If my creditors will increase, this number on the cash flow will go positive, which is payables. So this is positive. So I have delayed my payables. So that is why my cash flow will increase. So you can delay your payments. Sell debtors to a credit company. Suppose I have debtors and these debtors are not giving me money, and again I'm getting negative figures over here. I can sell these debtors to an asset reconstruction company and realize the cash. That is manipulation. Cut back on investments. How do you cut back on investments? I can start doing less capex, which is required to run my business. That is how I can increase my cash flows, right? Buy businesses rather than invest in new assets. A standard calculation of free cash flow might ignore this. That is deep. I discussed today this in the con call, and this is something which we had in the APL case study already posted in the group. So how do you find quality companies? Look for companies good sales record, good profit record, high signs, high ROC, high EBITDA, 15% ROC. Do a DuPont analysis, calculate FCFF, FCFE. Then you see how these ratios look on capex ratio. A capex ratio less than 30 means you are a good business. You don't need much amount of capex. High levels of ROC between 8 to 12 we discussed. look at free cash flow to per share and earnings per share. Free cash flow might be different in different cases. Look at that and how these things can be manipulated. So this completes around half the book. We have done 4 chapters. How to find quality companies. Next part is how to find dangerous companies. So let's see what is the next part. Let's go back to the index. How we have the chapter structure ahead. So for the next session we're going to do chapter 5, 6, 7 and 8. So we'll complete this part 2. Most probably tomorrow or day after we'll complete this part 2. We got 4 chapters to do. So carry on guys.